Why some investors say tech stocks are becoming less risky. The technology sector has long been thought of as the classic cyclical investment, with tech companies typically selling non-essential products and services to businesses and consumers, and their stocks often supported by high revenue growth projections that come undone during economic downturns. But according to some investors and analysts, market participants are beginning to re-evaluate just how cyclical the information technology sector remains, to the widely used global industry classification standard, which removed high-flying growth companies like Facebook Incorporated, FB and Netflix. The tech sector isn't as cyclical as it used to be, Dave Lafferty, chief market strategist at Natixis Investment Managers, told MarketWatch. He said that, while at the same time, some market veterans argue that the notion the tech sector is no longer cyclical smacks disturbingly of the same mentality that prevailed in the latter days of the technology bubble that burst in March 2000. Market leadership. Meanwhile, the evolving perception of the information technology sector appeared to contribute to the leadership role it's displayed since the market's recent lows on December 24. Since then, according to Norm Conley, Chief Investment Officer at JAG Capital Management, that outperformance can't just be chalked up to the sector's sharp decline in the fourth quarter of last year, as it was only the third biggest loser during that stretch. Even as we've had more questionable economic data, you see tech picking up the slack, he noted. These stocks are changing business model. Enterprise software used to be a big-ticket deployment. If you were going to Brad Sorensen, managing director of sector analysis at Charles Schwab, agreed that the information technology sector has become less cyclical, though he says confusion abounds as to what investors are talking about when they talk tech. People lump Facebook. The infotech sector is still on the cyclical side of the spectrum, Sorensen said, but investors are beginning to recognize that it is more defensive than in the past. To be sure, this isn't the first time that investors have claimed the end to tech's cyclical ILT. Richard Bernstein, echoes of the tech bubble. Anyone who lived through the late 1990s tech bubble is probably cringing now, wrote Bernstein. The basic principle. In an interview with CNBC, Bernstein said the notion that tech is no longer cyclical echoes tech bubble era arguments that it's something new. It's something different. In his note, Bernstein pointed to Apple Incorporated as a classic example of a cyclical stock that makes up more than 15% of the infotech sector. He pointed out that appliances are considered durable goods, and consumers don't mind paying higher prices because they mentally amortize the cost over the appliance's anticipated 15-20-year lifespan, he wrote. Mobile phones rarely. Sorensen pushes back by arguing that Apple and other infotech stocks like Microsoft Incorporated, MSFT, and we have seen tech sector companies increase their dividend payments, Sorensen said, which may become a larger part of total equity return in the near term, while they have also increased share buybacks, which helps to reduce available shares to be purchased. Tech confusion. Meanwhile, average investors may just be confused by talk about tech stocks, given the removal of companies like Facebook, Google parent Alphabet Incorporated, Goop from the info. For instance, the NYSE FANG Plus Index XXNYFANGU, which tracks shares of Facebook, Apple, Netflix, and Alphabet as well as other high-profile, high-growth tech names, rose 37% from its November 2017 inception to its peak in June of last year, while the information technology sector grew just 11%. But those stocks remain far more volatile than the more established information technology sector. Todd Rosenbluth, director of ETF and mutual fund research at CFRA, told MarketWatch that the investing community tends to blur the lines in terms of technology, lumping in companies across different sectors. FANG stocks were. The confusion is highlighted by the fact that SPDR's Communications Services ETF, which does contain Facebook and Google, is just one-third the size of its information technology counterpart. But as the market continues to adjust to the new classification and evolving business models, Rosenbluth says that Infotech ETFs are a smart investment now as the constituents offer a mix of growth prospects while having strong balance sheets and records of offering consistent dividends. Not scientifically valid. Results are up.
Raindrop, drip, drop top, top smoking, no cooking the hot pot. Fucking on your bitch, yeah, that.